Hello everyone, welcome back. And it's only been a few days since Wall Street started celebrating another record push in the major indexes. But underneath that celebration, something much more important is happening. The stock market is acting strong on the surface. The bond market is sending a completely different message. Commodities are waking up again, precious metals are refusing to break, and crypto is sitting in one of those uncomfortable places where confidence can disappear much faster than people expect. Today is Wednesday, May 6th, New York time. Before we go any further, comment below what day and date you're watching from, because I always like seeing how quickly these market messages travel. And just before we dive in, if you value this content and want to support the work, subscribe to the channel and comment "Our John AG" below. That lets me know you're here for the real analysis, not just the noise. So jumping in, another week, another market rally, another round of people telling you that the danger is past, that the indexes are fine, that the worst is over, and that anyone still talking about risk is just being dramatic. But this is exactly why investors get trapped at the worst possible moments, because markets almost never ring a bell at the top. They smile, they rally, they make people feel safe. And then, when enough people have lowered their guard, the real move begins. Now, based on recently published numbers, the S&P and Nasdaq have been pushing into new high territory again, helped by strength in technology, chip makers, and the artificial intelligence trade. And on the surface, that looks bullish. I understand why people are excited. When price is rising, nobody wants to hear about momentum, valuations, liquidity, or bond market stress. But here's the problem. A new high in price does not automatically mean a new high in strength. That's the part most people miss. Because if the index is making a new high while the underlying momentum is fading, that is not confirmation, that is a warning. And we have seen this movie before. Not exactly the same way, not with the same names, not with the same news headlines, but the same basic psychology. People fall in love with the leaders. The leaders carry the indexes hide weakness underneath, and then suddenly the air pocket opens. This does not mean stocks must collapse tomorrow morning. That's not how serious tops usually work. Serious tops are messy. They are slow. They give you rallies that look convincing. They shake out the bears. They create a final burst of confidence. And then, after everyone says the bear case is dead, the structure finally gives way. And that is why I'm paying very close attention to the difference between price and momentum right now. Because if the market starts sliding back under the upper 6,000 area on the broad index, not crashing, not panicking, just leaking lower, that could matter more than a dramatic headline. A soft move lower can be more dangerous than a loud one because nobody respects it until the damage is already done. And this is where I want to be very clear. The stock market is not the only risk. The bigger issue may actually be the bond market. From recent market updates, the long end of the Treasury market is still sitting under pressure, with the 30-year yield hovering around the 5% area. That is not a small detail. That is the cost of long-term money talking back to the system. And when long-term yields stay elevated, the Federal Reserve can cut short rates, pause short rates, talk nicely about short rates, or hint at future policy shifts. But the bond market can still say, no, we want more compensation. That matters because the entire financial system was built for years on the idea that bonds were safe, stocks were growth, and a traditional stock-bond portfolio would balance itself out. But what happens when stocks are expensive and bonds are not providing the shelter? What happens when the part of the portfolio that was supposed to calm the storm starts becoming the storm? That's the question investors should be asking right now. And this is also why I do not fully agree with the idea that money always has a perfect hiding place. Sometimes money rotates beautifully from one asset class to another. Yes. But there are also periods where liquidity gets tight, investors sell what they can, correlations rise, and almost everything gets hit at once for a while. So the smarter point is not that every asset will magically protect you. The smarter point is that capital eventually searches for what still has real value after confidence leaves paper promises. And that brings us to commodities. The broad commodity complex has been trading around the low 140s on a major commodity index, which is a big deal because commodities spent years acting like the forgotten corner of the market. Everyone wanted software, everyone wanted platforms, everyone wanted digital stories. But the world still runs on fuel, copper, food, shipping lanes, power grids, and materials that cannot be printed with a keyboard. This is where the story gets interesting. Because while stock investors are debating whether one more rally can squeeze higher, commodities are starting to look like the asset class that may benefit if capital decides it has had enough of financial engineering. Oil has already shown how quickly a headline can hit the real economy. The Strait of Hormuz situation reminded everyone that one narrow shipping route can shake energy markets, transport costs, and inflation expectations almost instantly. But I'm not going to tell you that every move in oil is automatically bullish for gold and silver. That's too simple. Sometimes high oil creates stress. Sometimes it pushes inflation fears higher. Sometimes it pressures consumers. Sometimes it forces selling in other assets. And sometimes, when the oil spike cools, precious metals breathe because the dollar relaxes and rate fears ease. That is exactly why investors need to separate the headline from the structure. Headlines move price for a day. Structure moves capital for years. And right now, the structure in gold and silver still looks more constructive than broken. According to the latest publicly available market data, gold recently moved back into the mid-$4,000 area, while silver has been showing strong upside days after a difficult stretch. But the important part is not one single daily move. The important part is that precious metals have absorbed volatility without destroying their larger trend. That is usually what strong markets do. They don't move in a straight line. They punish late buyers, they scare weak hands, they build ranges that feel impossible to sit through. Then, when everyone is tired of watching, they move. For gold, the key is whether it can reclaim the upper 4,000 area with strength. For silver, the important zone is the high 70s to low 80s. If silver can move through that area and actually hold it, then the conversation changes. At that point, we are no longer talking about a metal trying to recover. We are talking about a metal trying to reprice. And yes, I know the big silver targets sound crazy. $300 silver sounds ridiculous to a lot of people. But let's be careful here. Ridiculous does not mean impossible, and possible does not mean guaranteed. Silver is a smaller, more volatile market than gold. It has investment demand, industrial demand, and a long history of doing nothing for painful stretches before making violent catch-up moves. So could silver overshoot in a real commodity rotation? Absolutely. Could it also disappoint people who chase every breakout without a plan? Absolutely. That's the balance. I'm bullish on the setup, but I'm not interested in fantasy thinking. The strongest argument for silver is not that somebody drew a huge target on a chart. The strongest argument is that when capital leaves overcrowded financial assets, it often looks for under-owned assets with real-world demand, and silver still fits that description better than almost anything else. And miners may be where the leverage shows first, because mining stocks are not the same as bullion. They come with company risk, operating risk, political risk, energy cost risk, management risk, and dilution risk. But when the metal price rises faster than costs, good miners can move with much more force than the metal itself. That is why the mining sector deserves attention, especially if silver miners keep outperforming the broader precious metals mining group. Still, don't confuse leverage with safety. Mining stocks can reward you quickly, and they can punish you quickly. If you're successful, share your success story in the comments so others can stay motivated, because the best lessons usually come from people who stayed disciplined before the move happened, not after it was obvious. Now, while metals are trying to build strength, crypto is facing a very different test. Bitcoin is trading around the low $80,000 area, and Ethereum is sitting a bit above the low $2,000 area. That alone does not mean disaster. Crypto has survived brutal drawdowns before. But the issue here is confidence. Bitcoin was sold to many people as digital gold, a hedge, an alternative system, and a way out of currency debasement. But if it starts behaving like a high beta technology stock during stress, then investors will ask a very uncomfortable question. What exactly is it hedging? That does not mean blockchain technology disappears. That does not mean every crypto project goes to zero. But as an investment asset, confidence is everything. If Bitcoin loses major support again and starts moving toward much lower ranges, the pain will not just be mathematical, it will be psychological. People can handle volatility when they believe the story is intact. They panic when the story itself gets questioned. And that is the real risk. The same thing applies to Ethereum. If it holds important long-term zones, the bulls can keep arguing that this is another cycle shakeout. But if those zones fail, then a lot of investors who thought they were early may realize they were simply trapped in a liquidity trade. Now let's zoom back out. The deeper issue here is not stocks versus gold, or Bitcoin versus silver, or oil versus bonds. The deeper issue is trust. Do investors trust the value of their money? Do they trust the bond market? Do they trust the central bank? Do they trust political leadership to manage a period of high debt, high rates, expensive living costs, and geopolitical stress? And this is where we need to be honest. Some of the extreme claims floating around right now go too far. Saying the Federal Reserve will disappear in a few years is not analysis. It is speculation. Saying the entire tax system will stop working is not a forecast you can treat as fact. These things could be debated, but they are not investment plans. What we can say is simpler and more useful. When markets get expensive, debt gets heavy, and living costs stay high, public frustration rises. That can create political shocks. It can create policy experiments. It can push voters away from old assumptions. We have seen that pattern in other countries, and we have seen pieces of it in American history too. But you do not need to predict the end of every institution to protect yourself. You need to understand that the old playbook may not work the same way. A traditional portfolio may need more real asset exposure. Cash may feel safe but lose purchasing power over time. Bonds may still have a role, but they cannot be treated like automatic protection. Stocks may continue higher for a while, but expensive markets become dangerous when leadership narrows and momentum fades. Crypto may still rally, but it must prove that it is more than a liquidity toy. And precious metals may be volatile, but they are doing exactly what hard assets often do when confidence in paper starts to weaken. So as we wrap this up, here's what I'm watching. I'm watching whether the S&P and Nasdaq can keep making highs with real confirmation, not just a few mega-cap names dragging the indexes upward. I'm watching whether long-term Treasury yields stay near that uncomfortable 5% zone. I'm watching whether the broad commodity index holds its breakout area. I'm watching whether gold pushes back toward the upper 4,000s. I'm watching whether silver can take back the low 80s and hold. And I'm watching whether Bitcoin can defend confidence before another wave of selling changes the conversation completely. Because the market does not care how badly we want certainty. It cares about liquidity, positioning, and belief. When those three shift together, prices can travel farther than models, headlines, or opinions prepared us to expect, and they can do it fast. Because this is not the kind of market where you want to be asleep. This is the kind of market where the first move fools people, the second move traps people, and the third move teaches the lesson. If you enjoyed this breakdown, subscribe to the channel, leave a like, and comment below which asset you think wins the next big rotation: stocks, bonds, commodities, metals, or crypto. I want to hear where you stand because this debate is only getting started. And remember, none of this is personal financial advice. I'm sharing market education, risk context, and my own interpretation of the setup so you can think more clearly, ask better questions, and make decisions that fit your own situation. Talk with a qualified professional before making major financial moves, and never risk money just because someone on the internet sounds confident.